Over the past 2 years, corporations have invested an astonishing sum exceeding $10 trillion into the realm of artificial intelligence. Nvidia's stock value surged from a mere $150 to surpass $900 per share. Microsoft allocated $60 billion towards developing its AI infrastructure. Companies like Google, Amazon, and Meta, alongside virtually every other major player, are committing their entire resources to the pursuit of AI. Jensen Huang, the chief executive of Nvidia, asserts that AI will fundamentally transform every single industry. Sam Altman predicts that artificial general intelligence, or AGI, is imminent within a few years, prompting investors to inject capital with an unprecedented sense of urgency. However, a crucial aspect that seems to be overlooked is the fundamental economic reality. The current expenditure on building AI systems, amounting to hundreds of billions, is yielding negligible returns. The expected revenue streams are not materializing, the practical applications remain constrained, and the associated expenses are staggeringly high. This situation bears a striking resemblance to the dot-com bubble, only on a significantly larger scale. Allow me to illustrate precisely why $10 trillion in AI investments is poised to evaporate. Technology consistently follows a recurring pattern across generations. A novel technology emerges, hailed as a harbinger of universal change. This generates a torrent of investment, driving stock valuations skyward. Subsequently, reality asserts itself. While the technology proves functional, its widespread implementation and promised impact fall short. Anticipated revenues fail to materialize, leading to the collapse of companies that had invested heavily, and a subsequent market crash wiping out fortunes. This cycle has been observed with railroads in the 1800s, radio in the 1920s, the dot-com era in 2000, and cryptocurrencies in 2021. And it is now unfolding with artificial intelligence. This is not due to AI's inherent ineffectiveness. It functions demonstrably. Rather, it stems from excessively inflated expectations, extraordinarily high investment, and an opaque revenue model, rendering the current level of financial commitment unsustainable. Let us examine the specifics of this unfolding situation, present the relevant figures, and explain the inevitable downturn. We begin with the sheer magnitude of the expenditure, which is almost beyond comprehension. In 2023 alone, businesses dedicated approximately $200 billion to AI infrastructure, encompassing data centers, microprocessors, power systems, cooling solutions, and all the components necessary for training and operating AI models. This figure climbed to $350 billion in 2024, with projections for 2025 exceeding $400 billion. This amounts to nearly $1 trillion invested in infrastructure over a mere 3-year period. This calculation excludes the considerable sums allocated to research and development, the recruitment of AI specialists, the acquisition of nascent AI enterprises, and the creation of applications. This figure solely represents the physical hardware and energy required to make AI operational. Who is making these substantial investments? Consider Nvidia. They are not the primary spenders, they are the recipients of this capital. Nvidia manufactures the graphics processing units, or GPUs, which are the backbone of AI computation. In 2022, Nvidia's data center revenue stood at $15 billion. This soared to $47 billion in 2023 and is forecasted to exceed $100 billion in 2024. Nvidia's revenue has multiplied sevenfold within 2 years, with nearly all of this growth attributable to AI processors. Corporations are procuring Nvidia's H100 and H200 chips, priced between $25,000 and $40,000 each, in quantities numbering in the tens of thousands. A single cluster dedicated to AI training can cost anywhere from $500 million to over $1 billion. Every major technology firm is actively constructing multiple such clusters. Microsoft has invested over $60 billion in AI infrastructure over the past 2 years. This encompasses data centers, processors, power systems, and strategic stakes in OpenAI. $13 billion was directly channeled into OpenAI, with the remainder allocated to the infrastructure required to support AI services. Google has committed approximately $50 billion to AI infrastructure, developing its own tensor processing units, or TPUs, and acquiring NVIDIA GPUs. Meta has disbursed over $40 billion, and Amazon has spent more than $30 billion. These 5 entities, Microsoft, Google, Meta, Amazon, and NVIDIA's other major clients, including Oracle, Tesla, and smaller cloud service providers, have collectively expended over $300 billion in the last 2 years alone. And this spending is accelerating. The critical question then arises, what tangible benefits are they receiving for this enormous outlay? What is the generated revenue? Investing $300 billion can only be justified by a commensurate return, with a healthy profit margin. However, the revenue figures do not substantiate this level of expenditure. Let us analyze this on a company-by-company basis. OpenAI, the company that ignited this fervor with ChatGPT, reported an annual revenue of approximately $3.5 billion as of late 2024, a significant increase from $1 billion in 2023. While this growth is impressive, OpenAI is not profitable. It is incurring substantial losses. Reports indicate that compute costs alone are consuming over $5 billion annually, primarily paid to Microsoft and other cloud providers. Consequently, with $3.5 billion in revenue and over $5 billion in expenses, OpenAI faces a deficit of $2 billion. Yet its valuation stands at $150 billion, implying a valuation 43 times its revenue for an organization operating at such a deficit. Microsoft has integrated AI across its product suite, including Copilot in Office, Azure AI services, and Bing, powered by ChatGPT. However, the specific revenue generated from AI-centric products remains unclear, as Microsoft does not disclose these figures explicitly. Estimates suggest that AI contributes an annual revenue increase of roughly $10 to $15 billion to Microsoft's top line. While significant, considering Microsoft's $60 billion investment in AI infrastructure, it would take an estimated 4 to 6 years to recoup the infrastructure costs alone, assuming revenue remains consistent and expenses do not escalate, neither of which is guaranteed. Google's AI revenue primarily derives from cloud AI services and the integration of AI into its search and advertising platforms. Again, precise figures are not disclosed, but AI is estimated to contribute between $15 and $20 billion annually. Given Google's $50 billion investment, this suggests a break-even period of 3 to 4 years. This projection is optimistic, especially considering that Google's AI offering, Gemini, is largely provided free of charge to users, a strategy implemented to counter ChatGPT's market dominance. Offering a product that incurs billions in operational expenses is not a viable revenue model. It is a defensive maneuver to preserve market share. Meta has incorporated AI into its advertising targeting and content recommendation systems, thereby enhancing its core business operations. However, revenue generated from novel AI products, such as the Meta AI Assistant, is minimal. Meta has invested over $40 billion in AI and its Reality Labs division. The majority of Meta's AI features are provided to users without charge. Consequently, Meta is expending tens of billions to refine its advertising targeting, which demonstrably boosts advertising revenue. Nevertheless, isolating the incremental revenue attributable to AI is challenging. Consumer-facing AI products function primarily as cost centers. Amazon's AI applications are integrated into its AWS cloud services, Alexa virtual assistant, and fulfillment optimization processes. AWS AI services generate an estimated $10 to $15 billion in revenue. However, Amazon's investment in this area totals $30 billion, suggesting a multi-year horizon for recouping these costs. Alexa, despite being an AI assistant for a decade, has never achieved profitability, with Amazon incurring billions in annual losses on the product. Simply augmenting an already loss-making product with further AI capabilities does not address the fundamental issue. Summing these figures, the 5 major technology companies have collectively invested over $300 billion in AI over the past 2 years. The combined annual revenue generated from AI products across all of them is estimated to be between $60 and $80 billion, a significant portion of which is derived from integrating AI into existing services like search, advertising, and cloud computing. New, standalone AI products such as ChatGPT subscriptions, Copilot, and AI assistants contribute perhaps $10 to $15 billion annually. This presents a scenario where $300 billion in investment yields approximately $10 to $15 billion in new annual revenue, a 20-to-1 spending-to-revenue ratio. Under such circumstances, it would require 20 years of sustained revenue generation at this rate simply to break even, a time frame that is exceptionally long in the fast-paced technology sector, where entire industry landscapes can transform multiple times over. The situation is further exacerbated by the assumption of continued revenue growth. What if this growth falters? What if AI revenue plateaus in 2025 or 2026? In such a scenario, the investments would never yield a return. There are already indications that this may occur. Let us consider the practical applications. AI demonstrates impressive capabilities, including text generation, image creation, data analysis, and code development. These are tangible functionalities. The crucial question, however, is whether businesses and consumers will allocate sufficient financial resources for these capabilities to justify the substantial investment. Currently, the answer appears to be no. Most AI products are priced between $10 and $20 per month for individual users. ChatGPT Plus costs $20 per month. Microsoft Copilot is priced at $30, and Google One AI Premium is set at $20 per month. At these price points, generating substantial revenue necessitates hundreds of millions of paying subscribers. As of late 2024, ChatGPT has approximately 10 million paying subscribers. At $20 per month, this amounts to $200 million per month, or $2.4 billion annually, from consumer subscriptions alone. OpenAI also serves enterprise clients at higher price points, contributing to its total revenue of $3.5 billion. However, even with 10 million subscribers, the company is incurring billions in losses due to exorbitant compute costs. To achieve profitability, OpenAI would either need to implement significant price increases, which would likely alienate subscribers, or drastically reduce costs, requiring substantial advancements in efficiency, neither of which is assured. Microsoft Copilot has fewer than 5 million paying users, generating an estimated $1.8 billion annually at $30 per month. Google's AI Premium has an even smaller subscriber base, estimated at around 2 million users, translating to approximately $500 million per year. These figures are insufficient by a considerable margin to justify the current level of investment, and subscriber growth is decelerating. ChatGPT's subscriber growth has stagnated. The initial surge of interest has subsided, and the user base has stabilized. The number of new signups roughly balances the number of cancellations, indicative of a product that has reached its market capacity, which appears to be smaller than initially anticipated. Enterprise adoption is also proceeding at a slow pace. While businesses are actively exploring AI, its widespread implementation is both costly and complex. It requires integration with existing systems, extensive employee training, meticulous data privacy management, and the management of significant expenses. Furthermore, most organizations are finding that AI offers marginal, rather than revolutionary, improvements in productivity. A study conducted by MIT indicated that AI coding assistants, such as GitHub Copilot, enhance programmer productivity by approximately 26%. While this is a positive outcome, it is not a transformative leap and does not justify the immense infrastructure expenditures. Now, let us address the financial implications, as this is where the bubble is most apparent. Operating AI systems is exceptionally expensive, indeed, prohibitively so. Training a large language model, such as GPT-4, incurs compute costs exceeding $100 million for the initial training phase. Following this, there is the cost of inference, which involves running the model to process user queries. Each interaction with ChatGPT, for instance, costs OpenAI an estimated 1 to 4 cents, depending on the complexity and length of the query. While this may seem insignificant individually, it accumulates rapidly when multiplied by billions of queries. If ChatGPT handles 10 billion queries per month, the monthly compute costs for inference alone could range from $100 million to $400 million, amounting to $1.2 to $5 billion annually. These costs are not significantly diminishing. While NVIDIA's latest processors offer improved efficiency and software optimizations contribute to cost reduction, the overall expenses remain substantial. Moreover, as AI models grow in size and sophistication, their operational costs escalate. GPT-5, when it is eventually released, will inevitably incur higher training and operational expenses than GPT-4. Similarly, Google's Gemini Ultra is more costly to run than Gemini Pro. The prevailing trend is towards more resource-intensive models, not less. This creates a challenging predicament. To remain competitive, companies must develop more advanced models. These larger models necessitate greater investment, leading to increased expenditure. Unless revenue growth outpaces this escalating cost, financial losses will mount. OpenAI is currently caught in this cycle. To justify its valuation and compete effectively with rivals like Google, the company must release superior models. However, these advanced models are more expensive to develop and operate. and OpenAI's revenue growth is insufficient to absorb these escalating expenses. We must also consider the energy consumption associated with AI, which is rapidly becoming a critical issue. The training of GPT-4 required approximately 50 gigawatt-hours of electricity, enough to power 5,000 American homes for an entire year for a single training run of one model. Numerous models are undergoing training concurrently. The process of inference or running queries also consumes vast amounts of energy. A single NVIDIA H100 chip can draw up to 700 watts at full operational capacity. A cluster comprising 10,000 H100 chips, representing a mid-sized AI training facility, continuously consumes 7 megawatts of power. This is equivalent to the output of a small power plant. Corporations are building clusters containing 50,000 to 100,000 chips, which demand 35 to 70 megawatts of power continuously, 24 hours a day, 7 days a week. The electricity expenses are staggering. At commercial rates ranging from 7 to 12 cents per kilowatt hour, a 70 megawatt facility incurs annual electricity costs of $50 to $100 million. This figure excludes the additional 30 to 50% cost for cooling. Consequently, a single large-scale AI data center can cost between $75 and $150 million annually for power and cooling alone, and companies are constructing dozens of these facilities. The total energy consumption attributed to AI is projected to surpass that of entire nations. By 2027, AI data centers could consume more electricity than countries like Argentina or Sweden. This level of consumption is unsustainable. Power grids are unable to expand their capacity at the required pace, and the environmental implications are being largely disregarded amidst the prevailing hype. Let us now turn our attention to the stock market, where the signs of a bubble are most evident. NVIDIA's stock price has surged from $150 in early 2023 to over $900 by late 2024, representing a six-fold increase in less than 2 years. NVIDIA's market capitalization now exceeds $3 trillion, making it one of the most valuable companies globally. However, a significant concern exists. NVIDIA's valuation is predicated on the assumption that AI investments will continue at their current pace or even accelerate. If AI spending decelerates or ceases, NVIDIA's revenue is likely to plummet, with its stock price following suit. NVIDIA's price-to-earnings ratio currently stands at approximately 65. This indicates that investors are willing to pay $65 for every dollar of annual profit generated by the company. Historically, a price-to-earnings ratio exceeding 25 is considered high, and a ratio above 50 is indicative of bubble territory. NVIDIA's ratio of 65 suggests that its stock is priced for perfection. Any sign of disappointment, any slowdown in AI chip sales, could trigger a substantial stock correction. Such a slowdown is inevitable, as companies cannot sustain investments of $300 to $400 billion annually in AI infrastructure indefinitely. Eventually, they must demonstrate tangible returns. When they fail to do so, these investments will taper off. We are already observing precursors to this trend. In late 2024, several AI startups began to experience financial difficulties. Companies that had secured substantial funding rounds in 2022 and 2023 have depleted their capital on compute resources and staffing. They are now seeking additional funding, but investors are posing more probing questions regarding revenue generation, profitability pathways, and break-even timelines. Many are unable to provide satisfactory answers. The influx of capital is slowing, though not yet halted. To draw a parallel, the situation bears a disturbing resemblance to the dot-com bubble. In 1999, internet stocks experienced an unprecedented surge. Companies like Pets.com, Webvan, and eToys, many with no profits and inflated valuations, saw their stock prices soar. The Nasdaq index reached a peak of 5,000 in March 2000 before collapsing. By October 2002, it had fallen to 1,100, a decline of 78%, resulting in a loss of $3 trillion in market value. The companies that ultimately endured, such as Amazon, Google, and eBay, possessed viable business models with established revenue streams and clear paths to profitability. Those that failed lack these fundamental attributes, relying instead on user traffic, public interest, and hype without any sustainable income. AI in 2024 exhibits similar characteristics to internet stocks in 1999: extensive hype, astronomical valuations, and minimal revenue. The underlying technology in both cases is demonstrably real. The internet was real, and AI is real. However, the valuations are built upon assumptions that are proving to be unsustainable. In 1999, investors assumed that every internet company would eventually achieve profitability. This proved to be a flawed assumption for the vast majority. In 2024, investors are operating under the assumption that every AI company will discover substantial market opportunities. This is also likely to be an overestimation. While AI technology functions effectively, the actual market size is smaller than the prevailing enthusiasm suggests, and the associated costs are higher than initially anticipated. Consider a specific instance: Inflection AI, co-founded by Mustafa Suleyman, a prominent figure from DeepMind, raised $1.3 billion and developed a chatbot named Pi. While functional, it has not garnered significant user adoption, remaining largely free to use. In 2024, Microsoft effectively acquired the team and technology, reportedly paying $650 million for access to Inflection's innovations and to secure Suleyman's expertise. Inflection's investors received some capital back, but significantly less than the initial $1.3 billion valuation. The company had expended over $500 million on compute resources, model development, and infrastructure, generated minimal revenue, and was subsequently absorbed by Microsoft for its constituent components. This pattern is likely to repeat. Companies raise billions, expend them on computing power and talent, fail to establish viable revenue streams, and are either acquired at a substantial discount to their funding or cease operations entirely. Let us now consider the implications of the inevitable bubble burst, for it will occur. The only uncertainty is the timing. Historical precedents suggest that bubbles burst under one of three circumstances. Firstly, the failure of a prominent company, such as Lehman Brothers in 2008 or a major dot-com entity in 2000. When a highly visible player collapses, it triggers widespread panic, leading to a collective realization of the market's overvaluation. For AI, this could manifest as a major AI startup liquidating its assets after burning through billions, or a large technology corporation undertaking massive write-downs on its AI investments. Secondly, a cessation of revenue growth. When investors perceive that the promised growth is not materializing, they divest their holdings. This was observed with cryptocurrencies in 2022, as the market recognized that widespread adoption was not occurring as rapidly as anticipated, leading to a sharp decline in prices. For AI, this scenario would unfold when ChatGPT's subscriber growth demonstrably plateaus, when Microsoft reports that Copilot revenue is not meeting projections, or when Google acknowledges that Gemini is not generating significant new income. Such admissions are likely to surface, prompting investors to reevaluate their positions. Thirdly, unsustainable costs. When companies find themselves unable to sustain their current expenditure levels, they are compelled to reduce spending. This, in turn, negatively impacts the entire ecosystem. NVIDIA's revenue would decline as companies curtail chip purchases. Data center construction would halt, and layoffs would become prevalent. This creates a downward spiral. Reduced spending leads to lower revenues for NVIDIA and its peers. Their stock prices would fall, their market capitalizations would shrink, and they would subsequently cut their own expenditures, accelerating the contraction. While we are not yet at this critical juncture, we are closer than many people realize. The ensuing crash is likely to unfold as follows. NVIDIA's stock will be the first to experience a significant decline, given its extreme valuation and its direct dependence on continued AI investment. As AI spending falters, NVIDIA's stock price is projected to drop by 50 to 70% from its peak, potentially falling from $900 to $300 or less, erasing $2 trillion in market capitalization. The major technology giants, including Microsoft, Google, Meta, and Amazon, will also experience declines, though likely less severe, in the range of 20 to 40%. This is because they possess diversified business operations. However, their AI divisions will face substantial write-downs, amounting to tens of billions of dollars in impaired assets and data centers that are not generating the anticipated returns. AI startups are poised to suffer the most severe consequences, with an estimated 90% failure rate. Only those entities with genuine revenue streams and viable paths to profitability will survive. The remainder will exhaust their funding and cease operations, leading to widespread layoffs and the loss of billions in venture capital. While this scenario may sound dramatic, it mirrors the events of 2000 to 2002, when hundreds of internet companies failed, trillions in value vanished, and the industry consolidated around a select few dominant players. The same outcome is anticipated for the AI sector. A limited number of companies with robust business models and verifiable revenue will endure and prosper. OpenAI contingent upon achieving profitability, or Anthropic, if it can successfully scale its operations, may be among the survivors. Google and Microsoft are well positioned to weather the storm due to their diversified portfolios. However, the vast majority of the hundreds of AI startups focused on developing chatbots, image generators, and various AI tools are likely to disappear. Now let me address potential counterarguments. It is conceivable that my assessment is incorrect. It is possible that AI will uncover novel and substantial revenue streams, that businesses will willingly invest billions in AI services, or that consumer adoption will surge, leading to widespread subscriptions to multiple AI products. These outcomes are not entirely impossible. However, I believe they are improbable for several reasons. The practical applications of AI are presently constrained. While AI can generate emails, create images, summarize documents, and write code, once an AI system is proficient in these tasks, the need for multiple redundant systems diminishes. The market is likely to consolidate around one or two leading providers, leaving others with minimal market share. Enterprise applications are also limited. Most businesses do not require bespoke AI models. Instead, they need seamless integration with their existing systems, which translates to service revenue, rather than scalable product revenue. Services do not possess the same scalability as products, as each integration necessitates personalized effort, thereby limiting profitability. Consequently, even with widespread AI adoption by businesses, the revenue generated may not increase rapidly enough to justify the extensive infrastructure investments. Another counterargument posits that AI will become more affordable over time, citing Moore's law, which suggests a trend of decreasing computing costs. This could potentially improve profitability. While this is a plausible scenario, the pace of cost reduction is not rapid enough to address the current challenges. Although NVIDIA's latest Blackwell processors offer enhanced efficiency compared to their predecessors, they also come with a higher price tag. The net cost reduction per query might be around 20 to 30%, which offers some relief but does not resolve the fundamental issue. This improvement is further offset by the increasing complexity and size of AI models. GPT-5, for instance, is expected to incur higher operational costs than GPT-4, even with advancements in processing hardware. The ultimate counterpoint presented is the concept of artificial general intelligence, or AGI. This refers to the hypothetical scenario where artificial intelligence achieves such a high level of proficiency that it can perform any intellectual task a human is capable of. Should this scenario materialize, the potential for revenue generation would be boundless, with every job typically performed by a knowledge worker being superseded by AI. This translates to trillions of dollars in labor expenses that could be redirected as AI-generated income. However, two significant obstacles stand in the way. Firstly, we are still a considerable distance from realizing AGI. Despite the widespread enthusiasm, current AI systems are specialized, excelling at specific functions, but lacking the capacity for human-like reasoning, long-term strategic planning, or genuine contextual comprehension. AGI could be a decade away, or perhaps 50 years. The time frame remains uncertain. Basing investments worth trillions on technology that may not materialize for decades is a precarious strategy. Secondly, even if AGI were to be achieved, its economic viability remains unclear. If AI can perform any knowledge-based work, who will be the consumers? If AI displaces human workers, those individuals will lack the income necessary to purchase goods and services, leading to an economic contraction. This is the paradox of automation. Technology that eradicates jobs can simultaneously diminish the market for its own products. Therefore, AGI might not deliver the revenue windfall that investors anticipate. Instead, it could precipitate an economic crisis demanding a fundamental reimagining of societal structures. It is unlikely to generate trillions in recurring revenue for technology firms. Now let's address what actions you might consider if you have invested in artificial intelligence stocks, given that many individuals have exposure, either directly through companies like NVIDIA or indirectly via index funds with substantial technology allocations. My recommendation, which should not be construed as financial counsel but rather as an analysis, is that AI stocks are currently overvalued and poised for a significant market correction. If you hold NVIDIA shares purchased at a price exceeding $700, you are exposed to considerable risk. I would suggest considering the realization of some profits. For those who acquired shares at $200 or $300, substantial gains have already been achieved. Locking in these profits is advisable, as the impending correction will be swift and severe. investors in major technology corporations such as Microsoft, Google, and Amazon are in a more secure, though not entirely safe, position. These companies are likely to endure, but their valuations will likely decrease. A decline of 20 to 40% is a realistic projection. If this potential reduction in value is acceptable, then holding these positions is viable. Otherwise, reducing exposure would be prudent. For those invested in AI startups through venture capital funds or special purpose vehicles, it is essential to recognize that the 90% failure rate is a genuine possibility. These investments are akin to lottery tickets. Some will yield extraordinary returns, but the majority will become worthless. It is imperative to invest only what one can afford to lose entirely. For the majority of individuals, the most sensible course of action would likely be to decrease exposure to AI-related assets and pursue greater diversification. While attempting to precisely time the market's peak is ill-advised, so too is allowing investments to depreciate entirely. The presence of a bubble is evident, the only unknown is the timing of its deflation, and predicting such timing is an impossibility. Therefore, a gradual reduction in risk, the booking of some profits, and a reallocation into less speculative investments are recommended, coupled with patience. This is because the market downturn will eventually present opportunities to acquire shares in reputable companies at reasonable valuations. However, these opportunities will arise post-decline, not beforehand. Here is my projected timeline. In the year 2025, artificial intelligence expenditures will continue, albeit with a deceleration in growth. Instead of a year-over-year increase of 50%, the growth rate is expected to be 20%. This moderation will likely disappoint investors, initiating a decline in stock prices. By the middle of 2026, major corporations will begin to report that their artificial intelligence-related revenues are falling short of expectations. The stock price of Nvidia will have fallen by 40 to 50% from its peak. By 2027, the bubble will have demonstrably burst. AI startups will experience widespread failures, and valuations will have collapsed. The prevailing optimism will have been replaced by disillusionment, and the industry will consolidate around a select few successful entities. This marks the trough of the market cycle. By 2028 or 2029, the artificial intelligence sector will stabilize. The surviving companies will possess viable business models exhibiting steady revenue growth and profitability, with the technology seamlessly integrated into the economy at a sustainable level. However, the aggregate market capitalization will be a fraction of its peak value. Instead of $10 trillion, it might settle around $2 trillion, signifying a loss of $8 trillion. This pattern is typical of technology bubbles. The underlying technology is indeed valuable, but the initial enthusiasm and investment vastly exceed what the market can realistically support. The subsequent crash eliminates the excess speculation, allowing the survivors to rebuild on a more grounded foundation. In 10 to 20 years, this technology will be ubiquitous but ordinary, no longer a subject of hype, but merely essential infrastructure, akin to the internet, databases, or cloud computing. Its valuation will reflect its utility rather than speculative fervor. $10 trillion invested in AI over 3 years, yielding perhaps $60 to $80 billion in annual revenue, simply does not align financially. The associated costs are too high, the revenues too low, the practical applications more constrained than initially portrayed, and the stock valuations are priced for an unattainable ideal. This situation constitutes a bubble, not because artificial intelligence is fictitious, but because the expectations are unrealistic. When expectations clash with reality, reality prevails. The market downturn is inevitable. The only uncertainty is whether one will recognize it before it occurs.